This is the More Doors Podcast, episode 69. We are going to infinity and beyond today. We have a very special guest to talk about something we've never talked about on the show. We'll be right back with her and a really fun conversation right after this. All right, everybody, we are back with the More Doors Podcast, another episode 69. Before we jump into the show, we have a great guest today. Really excited to talk about this particular subject. She's awesome, too. Can't wait for you to meet her. Definitely want to give a shout out to my boy, Jesse Showalter with Tor Studios. Go check him out at torstudios.com. That's T-O-R-E studios.com. Mention that you know me. Mention that you heard about him on the More Doors Podcast. He'll make sure he charges you a little extra for that. Make sure you tell him that he's got a great beard. Best beard ever. Hashtag best beard ever. Also, go check us out, deepbluere.com, Deep Blue Holdings. Subscribe to the newsletter. Follow us on all the socials, and we'll make sure we keep you updated on all things real estate investing and multifamily. And without any further ado, I definitely want to introduce our guest today, Miss Erica Neal from Infinity Investment Strategies. How you doing, Erica?
I'm doing well, Matt. How are you?
I'm doing great. Welcome to the show. Thanks for finding some time for us.
Hey, thanks for having me. I'm excited.
Yeah, it's been a while. So you're also a podcast host yourself, so Real Money Talks.
Yes, it's going well. It's, the whole purpose is really just there's a lot of money myths out there. Mm-hmm. And so if we can break, and I always talk about the difference between math and money. If we can actually break down and understand how money works, then we can make it work for us. So that's the whole point of that channel.
That's awesome. I was brought into this whole infinite banking concept a couple of years ago, and I want to spend some time in diving into that because I know you're an expert in the subject. But you have a really long-standing career in various forms of financial services. So how did that start, and how did you get here?
Yeah, I appreciate that. I went to school, ended up graduating with I double majored in finance and economics. Go figure, I can't ever actually decide on something, so why not both? But got my double majored in that, and I was incredibly blown away by how money worked, right? So when I got into finance, I was just absorbed in this whole new world. I had never known about money. I knew what not to do, but I never learned how to make money actually work. So when I graduated, I was so excited, and I just was on this path of I want to tell other people how this works, right? If I can figure it out, anybody can do it. So I was out in West Texas, ended up getting a job in Fort Worth at a large investment firm as a financial advisor. So moved, cross country, AKA cross Texas. And with that, when I got hired by the big investment firm, it was great, wonderful. I learned a lot, got good training. And with that, it was when you work for company ABC, you're then told to sell product ABC. And what I mean by that is, the traditional financial advisory world is very focused on two things. They want to get a rate of return, right? Which is what they're going to send you on your pretty little pie chart statement. And they want assets under management. How much money can they bring under the firm? And again, I got great training and great team and all of that, but I started to realize there was a disconnect with actually teaching people how to put their money to work for them, right? We all know how to put money into an account. We all know how to get, an IRA funded or 401k or whatever, put money in, but actually teaching people, here's how you make your money work for you. Here's how you generate an income. That wasn't being discussed. And so I actually, was moving up through the ranks and started partnering with some senior advisors. And in that process, I started to see the senior advisors that had clients for decades. They, at that point, had clients for years and years and years, but they were closing accounts on a regular basis, meaning people just ran out of money. They closed the account and moved on to the next one all the time. And I'm like, I'm seeing right from the front end, I'm talking to people, we're doing planning and all this, but then I'm seeing the fruits of that labor on the back end just completely fall apart. And so it really didn't sit well with me. I'm like, this cannot be what my future holds, right? This cannot be the best way to do things. and a lot of other, issues I came across. But I ended up getting connected with a smaller boutique firm in Fort Worth still. And this boutique firm was an independent firm, which was really interesting to me because instead of just having one company and one product, we had a variety of companies we could use different, right? So if I met with Sally that needed something and John, right, I could use different things for different people. So with that being said, I had a lot more scope to do full comprehensive planning with a lot more companies. Additionally, we started focusing on income strategies, right? Like how can we maximize income in retirement? So started really focusing on that, niching down. I got introduced to the infinite banking concept. Additionally, the guy that ran this firm was the first advisor I had ever met that wasn't like, put all your money in the stock market or your life's gonna suck, right? He had real estate, he had businesses, like all these alternative investments. And so I actually did a couple of real estate deals with him. And so I started to realize like your life of cash flow and income doesn't have to start at 59 and a half or 65 or 70, right? Like you can accelerate that now. And so it was something I was really passionate about for myself, but also for others. And like I said, I got introduced to the infinite banking concept, which is this idea of instead of keeping all of your cash and liquidity in a traditional bank, and instead of locking up all of your cash and liquidity inside of an investment that you can't access without taxes and penalties, there is a way, there's this medium, intermediate term type account that you can bridge the gap between your everyday bank account transactions and your long-term investments and store your cash in a way that it can grow guaranteed, it's safe, it's liquid, there's tax benefits, you have control, there's privacy and asset protection, and. It was the perfect complement to everything else that I already had. And it still allowed me to use the cash inside of that account to go out and invest in more real estate. I'm in the process of buying a business now. I could use the money whenever and however I wanted. So it really brought the control back into my hands so that I can put my money to work in a way that makes sense for me. And so it was going from this niche down, this is the only way, to kind of having this epiphany of, hey, maybe there's more than one way that wealth can grow. Maybe there's more than one way to invest, and realizing, hey, we need to be able to have options and choose the best way to put our money to work for us instead of being pigeonholed.
Love that. And we're going to unpack so much of that. The fact that you said that without taking a breath is so impressive. You've done that before.
Yeah, it's a special skill. I need to include that on my LinkedIn profile.
Absolutely. Well done. And you have a very impressive LinkedIn profile, by the way. Nice job.
Thank you.
So I want to talk about kind of the growth of what I'll say alternative investment strategies, right? So I feel like over the last, I don't know, 7, 8, maybe 9 years, there's been the growth of the self-directed IRA and the self-directed 401k and, life insurance policies, which as I understand it is kind of like the denominator of what has become the infinite banking concept. So, what spawned that kind of subculture, if you will? Like, did people run out of traditional vehicles, IRAs and 401ks, or was there growth in self-employment that kind of drove these new alternative investment strategies?
It's so funny. I think most of the things that people do are heavily influenced by economic circumstances, right? So infinite banking, you're right. Infinite banking is the idea of instead of keeping cash inside of a bank or an IRA or any of that, you create your own private bank, right? You become the banker by creating and using a specially designed cash value life insurance policy. And I emphasize that very much so because this isn't just, hey, walk down the corner to your, insurance agent and just get a life insurance policy. Trust me, I've seen people do that. It doesn't work, right? These have to be specially designed. They have to be with the right company, the right cash, all of the IRS codes. So they're very strategically designed, but we're storing cash in there because of the IRS tax code 7702, by the way. And there's a lot of provisions within these types of policies that give you all of those features that I mentioned before. So with that, these policies are nothing new. They are the oldest assets on the books. The companies that we use have been around since 1850, 1870. So they've been around a very long time. They predate the IRS. They predate almost any other financial asset that people are familiar with now. So to answer your question, this has been around for hundreds of years, over 100 years, 150 plus years. So it's nothing new. The infinite banking has, been a time tested strategy for long term generational wealth. It's
Mhm.
not a get rich quick. It's not a silver bullet to solve all your problems. It's just a more efficient and effective way to store cash. And again, it was used from 1800. It actually, if you look all the way back to ancient Greece, farmers in ancient Greece would get together. They pooled their money because they didn't know whose crop was going to fail, but they figured at some point someone's crop is going to fail. So
Mhm.
they risk pooled, put money together, and then that way, when one farmer's crop failed, they could use that pool of money to help that farmer and his family get through that rough time when they didn't have crops to sell. And then the next year, they would all start saving money up and they would collectively use the money on an as needed basis. That was the first version of insurance ever put into place. And that was, again, used back in ancient Greek times. But when you fast forward, IBC's been used, infinite banking, life insurance, however you want to refer to it, has been used for a really long time. Now, when we look at what happened in the 70s, we came off the gold standard in 1972. ERISA got introduced. This was the first time that the average Joe could invest in the stock market because of mutual funds. Before that, if you wanted to get a diversified portfolio, you had to buy the full stock, right? So it was really expensive for the average Joe to be able to create a diversified portfolio. Well, introduce mutual funds, 401ks, all of this. So between coming off the gold standard and introducing mutual funds and retirement accounts, the stock market exploded. If you actually look at the S&P 500 between 1970 to 1999, that is the best 30-year run the stock market has ever had in its existence. The average rate of return was 14.84.
Wow.
So when we actually look at, maybe not our parents, but our grandparents, when they experienced this stock market, like that's why that generation is so passionate and so gung ho on, oh, put your money in the stock market, but because it worked for them. That is their truth, and that's their economic environment that they experience. So that's real to them. Now, for everybody else, as we got into 90s and 2000s, leading, we had the 2000 dot-com bubble bust, and then we had 2008, 2009, and then we run into COVID. So since then, we've seen that the market doesn't always perform that way, right? Not that it's good or bad, but that was an inconsistent and really weird time period that certain circumstances occurred to make it be so productive. Now people have started to see, oh, there's a lot of volatility. I can lose money. And I also know that life is really expensive, so I need to be able to make my money work for me now to help supplement my cash flow. So just based off of the new economy and the new way that, people need their money, they need more cash flow, they need more income, and they're starting to realize that the stock market isn't the end all be all to everything. That's where, and we had Robert Kiyosaki writing Rich Dad Poor Dad. So there's just been this new kind of like awareness of, oh, maybe the stock market's not the end all be all. Maybe we actually need to look at some of these alternative assets. And that's where, to your point, we had self-directed IRAs come in where they're like, oh, well, I've got, since 1970, they've been telling to put money into my retirement account. That's what I've done. But now I want to invest in real estate. Somebody saw that need. They saw the gap in the industry and they filled it. So where infinite banking comes in is saying, okay, well, now I think people are starting to realize, again, there's nothing that's good or bad. I want to point this out. There's no good or bad tool, but if you try to cut a piece of wood in half with a hammer, it's not going to work out very well. We need to figure out what you're trying to accomplish and then use the right tool for the job. So when I talk about self-directed IRAs, it's not that they're bad, but people have bumped into some issues with using an IRA to invest in real estate. And so they're looking for an alternative to say, what is a better, more effective or efficient tool that I can use to serve this purpose of putting money to work in real estate? And here comes the infinite banking concept.
That is the most thorough answer. I don't know if I could have imagined a more thorough answer. So you're amazing. Thank you. Thank you. So let's break this down. So I looked at infinite banking probably, I don't know, a year and a half, 2 years ago. And honestly, it was a little confusing to me. So the way it was explained to me was there was the kind of core life insurance policy. And then there was some kind of acceleration component that you would pay an extra premium for. And that would kind of grow the funds way sooner than they would have matured on their own. And you would you'd be able to access those funds and reinvest them elsewhere. Is that like a good 101 summary of it?
Yeah, it really is. And
Cool.
to relate that to something that might be familiar for most people, think about an asset that you own. Like if you buy a house or a property, right? You buy a property, you know what your mortgage is every month to actually purchase that property. As you pay that mortgage, you are building up equity inside of the asset, right? Same thing within your policy. If you buy a life insurance policy that has permanent and it has cash value, as you pay your base premium, right, the cost of the policy, you're going to build up equity in that asset over time. It takes time, but you will build more and more equity. To your point, though, can you pay over and above your mortgage to build up your equity faster? Put extra cash into that? Yes. And that's exactly how the policies work. You can put extra cash in the policy. It goes directly to your equity or your cash value. It accelerates the growth. You're earning compound interest and dividends on that. And all of that cash that's in there is available for you to use to go deploy it into anything and everything you want.
Gotcha. So, you know, I have syndicated a number of deals, right? We have some investors that use self-directed IRA funds. So that's an option. You can always, if you have a 401k through your employer, you can always take a loan and pay yourself back over time at, 4 or 5%, whatever it is. What are the advantages between infinite banking and one of those two options?
Yes, great analogy. So the key with infinite banking that I really like to emphasize is that first of all, it's a yes and, not an either or. And I tell my investors, business owners, that's the most people that we work with fall in that category. I would never tell you, hey, don't go put money in real estate, don't go buy a business, right? Let's put it in this life insurance policy. Right? Absolutely not. It's not an either or. It should be a yes and, that you're putting money into the policy and then deploying it into these investments. And when you put IBC into your system as a plug and play, there's what we call 4 key benefits, the 4 pillars of infinite banking that you'll see the benefit of. The first one is lower taxes. One of the biggest reasons and one of the biggest hurdles with using a retirement account to invest in real estate is that you lose all the depreciation. And guess what? Bonus depreciation, cost segregation is back at 100%, right? So when you use an IBC policy, your investment is treated same as cash. So anytime you invest in real estate, you're getting depreciation. Your money inside of the policy, right? You're putting money in and it's growing with growth and dividends. All that money is growing tax-free just like a Roth. And anytime you're borrowing against your policy, you're using that money tax-free. Now, when you borrow against your policy and you go use it to invest in real estate or anything like that, that interest that you pay on an IBC policy, if you use it for business or real estate, is considered to be a business expense. You can write that off as a tax deduction. So you're getting depreciation, you're writing off that interest, your money's growing tax-free, and when we fast forward down the line, you can, if you want to continue to invest in real estate, great. Or if you want to call me and say, hey, Erica, I don't want to put money in my policy, I want to take it out and use it as income, it'll spit out a guaranteed tax-free income to you for the rest of your life. So it's a tax-free income source. And then lastly, when you pass away, everything you leave behind in the policy is tax-free to the next generation. No inheritance tax, no estate tax, no wills, no probate, nothing. This is the most efficient way to transfer wealth from one generation to the next. It's a great book called What Would the Rockefellers Do? And I think those guys know a little bit about generational wealth, but they've used life insurance policies. So the first one is lower taxes. The second one is control. I think all of us in this entrepreneurial space, we have control issues. I mentioned mine earlier. The question that I get with the policy is how much do I have to put in? And that's the thing is, it's up to you. There's a minimum you set, there's a maximum, and you can go anywhere in between. So there's a lot of flexibility about how much you're putting in. And then the other question is, once my money's in there, what can I invest in? A lot of self-directed IRAs have prohibited transactions and prohibited persons. There's no prohibit anything, right? You can go to Vegas and put it on Black 22 for all we care. We don't recommend it, but do whatever you want. And when you're taking these loans against your policy, you pay them back how, when, and if you want. Is your deal taking too long to cash flow? I'm in a deal that went belly up last year. That sucks. So if I want to, pay back that loan or not, I can decide how I want to do that. So you have control over the payback schedule. The third one is lower risk. So this is asset protected money inside of the policy. Your cash is shielded and protected from creditors, from predators like lawsuits. We have no threat of illiquidity because any A-rated company that we use is required to have a 100% minimum reserve account. So every dollar they have is backed up in reserves. And then you're also protected against lawsuits, creditors, and market correlation. So all these are guaranteed. The last one is leverage, and this is the key. This is where a lot of people are like, wait a minute, what's going on? Yes, you can use your policy as, net worth and liquidity on your PFS. You can hide your assets if you don't want to disclose them. Like my oldest is about to go to college, so when I'm filling out her FAFSA, you're darn sure I'm not putting my IBC policy on there. But if I want to syndicate and I want to show that I'm an accredited investor, then I can use it on my statement. Now, when you go to borrow against your policy, let's say you have 100,000 in there and you want to take out 70 to go into a deal. You take out 70 as a policy loan and you pay simple interest on that policy loan. So you're paying simple interest on the 70, you go invest, you're getting your rate of return, you're getting your cash flow. The entire time your 70's out there working and growing for you, you're still earning compound interest and dividends on the full 100. So now you're putting $1, giving it multiple jobs. So you're getting two rates of return at the same time, in addition to the tax benefits, the control, and the asset protection. So it's not it's not a silver bullet or a one size fits all, but it's all these little efficiency tweaks that help enhance the business owner and the investor's portfolio.
Amazing. You said something a few minutes ago. So as I understand it, in a self-directed IRA, you cannot invest your own funds into your own deal, like as a GP.
Correct.
Is there that kind of limitation with infinite banking?
Nope.
Really?
Yeah, there's no limitations at all.
Interesting.
You can, again, I'm got a kiddo going to college. I can use it to go to college. I can use it. I have a client that actually just bought a box truck. Mm-hmm. He has an installation company here in Fort Worth. He needed cash. He didn't have time to go full with the bank. He's like, hey, I need like $65K to go buy this truck. Cool. Got the money sent to him.
Wow.
You can use it for anything and everything you want.
And so let's pull the thread on that sweater for your example, right? So you have a client, he needs a truck, he tells you he needs $65K. Mm-hmm. Like, is there forms? Is there a process? How long does it take to actually get the funds from request to account for funding his account?
Most of the companies that we use, because we're independent, we have a couple of different ones. We have our favorites, but there's one company in particular that we can process any transaction for our client. I think it's less than 25,000. We can just do it over the phone. Any other transaction, they have a form or e-signature that they require. So how we do it is if somebody says we want it, we email them the e-signature. As soon as they e-sign it, we submit it, we process it, we handle everything on the back end for them, and they have their funds within, I say 3 to 5 days just to be generous. If we need it faster, we can, but, just for safety and protection, we just say 3 to 5 days.
Gotcha. Okay. And if you look across your client book, is there a specific profession, demographic, background of folks that are believers and practitioners of IBC?
Oh, that's a really good question. We have a huge array of people. We have brand new people, like one lady hasn't even bought her first deal, but she understands the value of this and how IBC is going to impact her long term. We have other people, like we're doing a 7-figure policy this year. This guy wants to put a couple $1 million in there because he is more focused on asset protection, meaning he's already built his portfolio. He's already got it. He wants to start shielding and protecting his assets. And there's an estate plan, right? We're starting to look at, he's young, but he also understands the future and everywhere in between. I would say the people that in general, if we look at all different stages of life, the people that understand and see the value of infinite banking are tired of being told what to do with their own money, right? Like, I'm so sick and tired of giving my money away to somebody else. And, I always make the joke that, the R in IRA, do you know what it stands for? Restriction, right? You can't do this, you can't do that. And so many people get fed up with that. Additionally, I'm sick and tired of giving my money to a bank when all they're going to do is pay me 0.2% and lend it out at a lot more, right? They're going to lend 7, 8, 9% or more. And just so people, I don't know if people know this, as of March 15th of 2020, the Federal Reserve lowered bank reserve requirements to 0%. Wow. There's no reserves in banks. And so we have this industry that's making asinine returns. They're lending the same dollar 10 times. Somehow they're making hand over fist on returns, yet we've had to bail them out almost 3 times now in the last 10 to 12 years. They have proven to be horrible stewards of our money. Horrible stewards of our money. They're doing nothing but causing inflationary and financial issues. Do banks serve a purpose in our financial picture? Yes. Do they need to be the ones that are storing and protecting and being the stewards of your cash? As far as I'm concerned, no. I want to keep as little money in the bank as possible. And that's why, again, I store it in my own private bank because I'm going to be a better steward of my money than they are. If anyone is going to get arbitrage and tax benefits on my money, it's going to be me. And to be honest with you, I don't want to be told what to do with my money and when. So it's not necessarily a financial demographic or even a business demographic. It's more of a mindset, right? Like, let's bring back control of our money. Let's stop giving all of our compound interest away to these outside entities and just bring it back into the central nucleus of you and your family being in control of your money, right? We've given it away and we've dissolved it. We have wealth erosion. We have people who, we're losing money from generation to generation, and it's because we're not efficiently managing our cash. And that's it.
Gotcha. You're so passionate about this. I love it.
Just a little bit.
Yeah. So let's speak in context of multifamily real estate investing, which is something that you and I are both involved in and passionate about. So let's say you have John and Susie Smith who walk in and they fit into the accredited investor bucket, which means that John by himself makes 200 grand, or Susie by herself makes 200 grand, or they combine for 350,000 in annual income. They walk in, they have no idea about infinite banking, and they're like, Erica, how much do we need? And like, how does we talked about the how does it work already, but like, what kind of guidance would you give them? Let's assume that they're 40 years old, they've never done this before, they don't have any other life insurance policies. How do you guide them through kind of planning their journey?
Yes, I love that. The big key is guidance, right? And before, I always like to say that clarity provides confidence. It's really hard for people to have confidence in a plan if they don't have clarity on all of the behind the scenes and the why. So we are very, very focused. Infinity Investment Strategies, my team and I are very focused and dedicated to the education of people before they ever move into becoming their own banker. So we have a process we walk through. The first one is very much, what is IBC and why? So why are we using IBC? Why is this something that should be a part of your overall portfolio? And we dive specifically and deep into each of the 4 pillars. So, I mentioned those earlier. So we do a deep dive. We have visuals. We're talking through, again, the funding, the taxes, all of those different details. We give a full picture of what does this look like when you put it into your portfolio. So that's step 1. Step 2, we come back and say, okay, let's have a second meeting. And we say, all right, now that we understand what infinite banking is and why we're using it, now let's look at the how. How do you actually take money out of your policy? How do you put it into a deal? Let's look at the cash flow. How does the arbitrage work? If I'm paying interest and earning interest, how am I increasing my return? So we go through the mechanics of using your cash value to go into a deal or, buy a property, whatever your example is. And we actually show some mechanics behind the scenes of this is what's happening. And then at that point, John and Susie might say, hey, I like this. I like the strategy. I get the idea. What does this look like for me specifically? Now that I understand, I need to know the specifics of my circumstance. And that's where we say, okay, let's get into the nitty gritty. We get some financial details. We, go through some, fact finding with them. And once we get the scope and details of their income, their cash flow, what's their timeline? Are we going to have a big liquidity event next year, 5 years, 10 years, right? Like, what are all the pieces of the puzzle? Because the strategy is what it is, but how you use it, I use it, and all of those plans are going to vary. So once we have those details, we come back for that third meeting and say, okay, we understand the idea, we understand the concept. Now let's get into the nitty gritty of, if you put X in, let's look at year 1, year 2, year 20, right? So we actually look at a full scope plan of exactly how a policy would work, what their cash value is. Do they want a big death benefit? Do they not want a big death benefit? Right? All of those. I like to use the example of getting fitted for a suit. You go in, right, and say, it's tight here, it's loose here, and we make all those fine-tune adjustments. So at that point, they know this is exactly what it's going to look like for me, and they can decide how they want to do it, what makes sense. And, Matt, I know you and I talked about this a little bit before. it can seem daunting to get into this. It's really not. It's not difficult. It's just different. But our recommendation for folks is start at a level that you know you're comfortable,
Mm,
because think about your bank account, right? This is infinite banking. Think about your bank account. When you got your first job at 15 or 16, you didn't just walk up and put a big lump sum of money into it, right?
right.
You had a little bit and you started saving on an incremental basis based on where you were. And then as your career and as your job and as your income changed, your funding into your bank account changed. These policies work the exact same way. You can start at a level that you know you're comfortable and set it up so that 5, 6, 10 years down the line, when we want to make your policy bigger, or if we want to start layering policies on top of each other, right, and creating a waterfall, then we can do that. So it's not just a one-time transaction. This is a lifelong wealth building strategy, and that's why it's so important to work with somebody who understands the strategy, who understands your investments, and can actually create a plan that's going to bring all of those together. So it again, it's not difficult. It is different. So it just takes a little bit of time to map out what those details look like, and then just continue the process of strategizing and continuing education as you go.
Love it. So let's go back to that example, though, right? So John and Susie, homeowner, they're making 350 grand a year. They're they're both 40 years old. They both have every intention to work until they're 65 for whatever reason.
Mhm.
How much, like, are you thinking about starting coverage based on a certain multiple of annual income? Is it kind of a total nest egg number that they want to build by the time that they're ready to retire? How does that conversation start?
Yeah, we like to look at it from the lens of, well, one, we're going to look at like current liquidity. Sometimes we've had a big liquidation event. We're like, hey, I've got a butt ton of cash sitting here I need to do something with. That happens every once in a while. Sure, we can address that. Most people are saying like, hey, I want to use this as my private bank to save into. And at that point, we're going to look at it from like a percentage of income. Most people are pretty familiar with that. They're comfortable with that. And, I think the average recommendation is saving 10 to 20% of your income every single year is what's recommended. So when we look at that, we say, all right, if you're looking at this from a minimum standpoint, let's say 10% of your income, let's apply that to the minimum, right? Maybe it's 8, maybe it's 10, right? Give or take. But if we use 10% as a minimum, saying, hey, I want to be able to put this in every single year. This is my minimum savings goal. Great. And then you have the option and the ability to save more and put more in when you have a good year, when you have extra cash, or when you're just wanting to store money in a place that you can get to it quickly and easily. Maybe you want a couple months, maybe you want a couple of years. So 10 to 20% is the typical savings range for people. But when we're looking at an IBC policy, we usually start at about that 10% range and then give you the ability to put more in if and when it makes sense.
Got it. Maybe the answer to this question is dependent on case, but when you say 10%, are you thinking gross or net?
It depends on what industry they're in. So
Got it.
if we are in real estate and we have depreciation, we typically look at gross, because gross and net are going to be, hopefully close to the same with little tax liability. And then on the back end, if we're working with somebody that has a W-2, then a lot of times we're going to look at the net.
Gotcha. What's the other than the depreciation, is there any other difference as to why you would differentiate between the two?
Because most of the time, real estate investors are wanting to accelerate the cash a lot more than a W-2 person. And so if you want a higher maximum to be able to put more cash in, the higher your maximum, the higher your minimum. The lower your minimum, the lower your maximum. So we just really find that sweet spot to say, hey, I want to get as much cash in as I can. Great. This is where that minimum is going to fall in.
Got it. Got it. Now, let's play another example here where you have a couple that's coming in. They want to talk to you. They're interested in this, but they really don't have any interest in investing in a syndication or buying a business, or they don't need to buy a new box truck because they're not in the HVAC business. And they're just looking for, kind of a slow and steady wins the race type of approach, but they heard something cool about IBC and they wanted to investigate it. Is IBC a good product for that type of profile?
Yeah, that's actually how I got introduced to IBC. I was in that space. I was, mid to late 20s. Didn't want to stock everything away in a 401k. Obviously, that's concerning. But I knew keeping money in a bank was counterproductive. So this was that intermediate way for me to save money in a way that it was going to outpace inflation, but I could get to it if and when I needed it, but it was going to benefit me over the long run as well. And it is that slow and steady. So one of the strategies I don't talk about a whole lot is being able to, if you are in the W-2 path or you're just wanting to save money for the long term and retire at 65, that's great. These policies are a fantastic bond alternative to your retirement plan. So if you have a 401k, 403b, IRA, whatever, you have your investment account that you're saving for retirement. Well, these IBC policies can act as the conservative portion of your policy, of your savings. And the benefit is, one, it's going to have Roth-like treatment, and there's no income limits, there's no contribution limits. Think about the limitations on Roth for a minute, right? Like, if you make too much money, you can't contribute. And even if you can contribute, there's a $7,000 a year maximum.
Yeah, what are we doing with $7,000 anymore? I don't get it.
Well, the government does. They get it, right? Like they know how much money, the government knows how much money they lose in tax revenue by allowing money to take all the post-tax benefits. There's a reason that your 401k that's pre-tax, if you're over the age of 50, you can put like 53 grand into that thing. But on your on your Roth IRA, you may or may not be able to contribute. You can put in 7,000. If you're over the age of 50, I think you can put in 8,000. Right? Like, why is there such a discrepancy? Because the government knows how much money they lose on those post-tax and how much you win. So that's why they limit it, number one. And so with that, if you want to be able to save money in a post-tax way, get the Roth benefits without all the restrictions, and have this as an income tool when you get to retirement, if you only have money in a 401k or an IRA, when you get to retirement, you're going to be stuck on what's called a Monte Carlo simulation, a Monte Carlo curve. Essentially what that means is because the market fluctuates and we don't know how long you're going to live, you can only pull out about 3% of your money a year if you want to have a 90% chance or better of not running out of money for 30 years. So if you have $1 million in your 401k, you can pull out about $30,000 a year pre-tax, and that is the safe amount to pull out in retirement. That doesn't work.
Yeah, it doesn't work.
So by having these policies as a bond alternative, there's, y'all, I could nerd out on this all day. Dr. Wade Pfau, he is the professor at the American College. He is the guy that writes all the curriculum for the licensing to become a CFP and all of those financial designations. He did a case study, and he actually showed that by incorporating these cash value policies in combination with a 401k, instead of being stuck on a 3 to 4% withdrawal rate, by having an IBC policy in retirement, you could get closer to 10 to 13% withdrawal rates.
Wow.
10 to 13. It is insane. So it's just, when we really look at it on the long term, if we're looking at income, how can we get off of Monte Carlo, not be subject to market volatility, taxes, and all the restrictions? This is just going to be a very effective bond alternative with additional tax benefits.
Amazing. Love that. The whole Roth thing just boggles my mind, and I think you answered the question extremely well. But when I first, I mean, I haven't qualified for a Roth IRA in probably 20 years, right?
Yeah.
It's a good problem to have. I'm not complaining about it, but I'd still like to find tax shelter.
It's a problem nonetheless, right?
Exactly. The limitations on that. I mean, even 401k, what is it, 23,000 a year now?
Yeah.
But I mean, it's still not enough. As a country, I just don't think we're saving enough money for the future.
Absolutely.
Yeah, and we can go into Social Security and all that stuff. So listen, Erica, we're a couple minutes away from the end of the show. I want to be considerate of your time. I do have a question that's not related to IBC that I want to ask, and it's something that's come up on all of our episodes as of recently. So there's this thing out there called AI, right? Talk to us a little bit about how you are latching on to AI in your business and or personally to, accelerate the growth of your business, or where do you place AI in your day-to-day at this point?
I think it, at this point, is non-negotiable. I've started incorporating it a lot more. My mastermind they are leaps and bounds ahead of me, so I'm really leveraging their knowledge. In fact, I actually took a couple of recordings of webinars that I did about infinite banking, plugged them into AI, and I had them analyze it. And I told it exactly what I wanted, what's my target market, and I said, hey, this is what I'm trying to accomplish. This is what I'm doing right now. And I connected it to my PowerPoint, my Canva, all the things. And it actually spit out an analysis that it said, okay, this slide, this is what you said. This is good, maybe not this. And it critiqued every single slide. It even came up with a option to add additional slides and say, hey, you might consider looking at this. So we actually reformatted our entire educational process around what AI said, hey, this would be really good. We're getting good feedback on it. It's pretty new. But I'm also right now building out my first AI agent to be able to provide summaries and follow-ups for clients based off of our conversation. So when we wrap up a conversation, the transcript, the meeting transcript is grabbed by AI. It takes the transcript, it summarizes it in a pretty little PDF, and it says, hey, this is what we talked about. These were the key Q&As. Here are the next steps. Within 5 to 10 minutes of our meeting being done, it emails it out to the client and it saves it in our files for the client so that the next time we connect, guess what? I can go back and refresh and review. Like you said, Matt, you and I haven't spoken in a year. So there's a lot that's gone on since then. So this is a great way for us to stay on top of our clients and say, hey, how was this going? What was this project? As well as many other things. It's helping me minimize my time on my email, on my scheduling. And so it's just putting it to work, figuring out what's the 80% that you're doing that you shouldn't be doing, and the 20% that's going to drive your business forward. Focus on the 20, outsource the other 80, and there's a high chance that AI is going to be able to fill a big part of that void.
Great answer. You're chock full of great answers today. I love
I
it.
appreciate that. I'm really passionate about AI. It's starting. I've used it a little bit, but I'm starting to utilize it more and more, just from a value add perspective and a non-biased third party to kind of run my thoughts through.
Yeah. What you said about the transcripts really resonates with me. So we did a quarterly business review for my team back in April, and we had some folks that were attending virtually. So I had my meeting recorder going all day. We use Motion, which is really cool. And at the end of the day, I took the transcript and I threw it into Claude and I said, give me feedback on my presentation, summarize all the action items, because nobody ever keeps track of the action items in an all-day meeting, right? They have the
Right.
whiteboards, somebody erased it, whatever, and then give me direct feedback on the performance of everyone on my team. And it took it like 10 minutes. And it spit out like checkbox action item to-do list between me and everyone on the team, gave me some critical feedback on things that I could do differently next time, gave me like really good assessments on how my team was doing. And I mean, that's just something that would not have gotten done
Yeah.
on my own if I had to do it manually. And it's just been super eye-opening. So I love the transcript thing. I got to get more into a habit of doing that. I get these executive summaries every day from Motion at like 6 o'clock, and I love them, but I hate them because it
Yeah.
says you were in too many meetings today, and you did not have enough productivity time. And I'm like, well, then block them off my calendar so I can get some shit done. Like, come
Yeah.
on, you're supposed to be able to do this. Do it. But you know what? I haven't told it to do that, so I can't
Right.
really fault. It's my fault. Anywho, thanks for sharing that, Erica. For those people that don't know you, where can people find you?
Yeah, I'm on all the socials. I'm not on Twitter, LinkedIn, Instagram, Facebook, TikTok. So all the old lady social medias. I'm at the Erica Neal, EricaNeal, YouTube as well. And then our website and my email. I'm Erica, Erica, at infinityinvestmentstrategies.com. We've got a variety. We have a free resource library on our website. If you want to check that out, there's plenty of downloads on there that touch on a lot of what I mentioned, as well as talk through some ideas of taking infinite banking, which is just an idea of storing cash inside of a policy. But there's a couple of resources on how can this apply to different scenarios, be it real estate, business, passive investors, and everywhere in between.
Great. Anyone who's on listening, go check out Erica. Go check out Erica's website. I've known Erica for a long time. She's out there at the conferences. She's not shy about who she is, what she does, and who she talks to. She's also very familiar and very active in the real estate community. So go give Erica a shout. Follow her on LinkedIn. Erica, you've been awesome. This has been a great episode. First time we've ever talked about infinite banking, and you definitely did not disappoint. So thanks for spending some time with us today.
Thanks, Matt. I appreciate it.
Absolutely. Everybody, thanks for listening. This is episode 69 of the More Doors podcast. Go, whatever channel you're on, whatever platform you're on, go down below, smash that subscribe button, as my son would say, and we'll see you next week with another episode.